Okay, I think we can start this afternoon session where we will be looking on the sectorial impacts of TISA. We have four sectors presented here on the panel: financial services, transport, health, and education. Before we enter into four presentations of 10 to 15 minutes each, I thought that I'm going to abuse, but this is with the agreement of the organizers, I thought I'm going to abuse of my role as a chair and share with you some of the economic background of why this discussion is so important. I think what we really are talking about when we look at corporate globalization, we actually talk about inequality. And it's inequality that requires the regulatory capacity of sovereign states, or wherever regulatory capacity is actually dealt with, be it on regional level in the European Union or at nation-state level. Why am I saying this? A bit of political economy here. It's not Thomas Piketty, as you might expect, but it's something a lot more easy. We do have a huge, and this is a result of 30 years of the neoliberal agenda, we do have huge disparity in income distribution, but not just income distribution, where we look at flows, but also disparity in wealth distribution. So there we look at stocks. And just as one example, I've taken the European Union figures here. There are the net balance of financial assets, that is, financial wealth minus potential debt. So we're talking about net wealth, amounts to 31 trillion euros for the EU 28. If you consider a moderate interest rate of 2% each year on those liquid financial assets, you get to 620 billion a year. Compare that to the EU GDP, which is roughly 13 trillion, and then calculate very easily how much the annual GDP of the European Union as a whole has to grow to satisfy an interest rate of 2% on financial assets. In nominal terms, that amounts to a growth rate of 4.77% every year. Now, deduct from this the inflation target of the European Central Bank, which is shared also by the non-euro area countries, of 1.9 or 2%. It still requires real GDP to grow at almost 3% a year just to satisfy the 2% interest demand on these financial assets. As long as those 2.87% real growth is not achieved, then the disparity in income will grow further. Or, as we can see here, the wage share relative to GDP will fall. Now, this is the global level, but the EU level looks almost the same. And this is despite of an enormous growth in the global labor force. Another aspect of the economics of that. The borderline 100 is GDP, global GDP. No, sorry, OECD GDP. Yeah. Relative to that, trade, measured as the sum of import and exports, has grown 1.5 times as fast since 1980. But what has grown much more and much faster is financial integration. And financial integration defined as the sum of cross-border liabilities and assets, where we've seen until the financial crisis an increase that was 7 times GDP. Now, what is happening with all these financial assets? They're not invested into real stuff. They're not going to the real economy. And also, just as an exemplary figure, it's 2/3 that of these assets that remain in the financial sector. Yeah, it's speculation. It's interbank markets and so on. So the growth of integration, of financial integration, as one sectorial aspect of globalization, doesn't actually serve real needs and doesn't serve the real economy. And another exemplary graph, we could do that for many countries or for many regions, is a disconnect between what economists call savings and investment. Normally we're being told that companies must make profit in order to reinvest and to foster employment. That's no longer true. It's no longer true in a sense that everything goes into profits and then is recycled in any kind of way within the area of finance. So many things you can hear about the benefits of cross-border or global market integration. Have a look at financial markets and you start asking questions whether this is actually true. I'll skip that. No, I don't skip it. Look at the circle in red, where you see what Richard Koo has called a balance sheet recession. I'm not giving a talk about that. That would take an hour at least. But if you see that all economic agents are trying to make savings, that is, spend less than they earn, they have a surplus. And including companies who are accumulating savings rather than getting back into debt for future returns on investment. And what we're talking about in these plurilateral or multilateral trade agreements is the attempt of corporations to get a bigger share of the private savings of households, and to narrow the red dotted line or the distance between the red dotted line and the blue line. In this situation of excess liquidity, there's roughly 5 ways of dealing with it. The most traditional war has always been the physical destruction of the capital stock, At least in Europe, that's become a bit out of fashion. We're exporting wars, but the trouble is these wars don't destruct or don't destroy our own capital stock. Second, has been really effective in the past, privatization of common public goods, but here we're seeing increasing resistance in civil society. Take water. Extremely effective has been the third way, mainly to launch debt-financed bubbles. The trouble is they cost a lot, and this financial crisis is still not over, and it's still relatively fresh in memory. Fourth way is to look at very conservative US economists who are advocating, like Carmen Reinhardt, who are advocating a one-off levy on wealth of at least 3 to 4%, or to get back to very high personal income tax rates and corporate tax rates, and to make sure that not everything is channeled into profits, but rechanneled to the secondary distribution system of the welfare state. And the fifth is a totally different agenda. That is my organization that has proposed a kind of public equity program that would collect private money and invest it into the real economy to meet the needs. So with that, I'll stop here. And I thought the political economy of the discussion we are having today was an element that was a bit lacking. And thanks for the attention. And I now turn to the panel.